Hello everyone, this is Market Daily, where I bring you the latest in trends and money. Please like and subscribe for more contents and research. Your supports go a long way. Today I want to bring to your attention the market corrections of December 18. Pundits blamed the market plunge on Fed hiking rates, the China trade war, the fears of economic slowdown. But recall that 1. The market recovered in a V-shape days after December ended, without the Fed deciding to reverse course on a rate hike. 2nd, the market was unfazed by trade war headlines nearly all year long. And 3, the economic growth data remained incredibly positive and strong. The December 2018 drop was irrational. Let me remind you that it was irrational, just like today or last week. So this look back at a recent history goes to show how irrational markets can be, and it is up to us to take the advantage. So for today, there are 3 things I want to emphasize here. 1, the Fed is not raising rates and have said this repeatedly. 2nd, the economy is recovering and there is little data suggesting any upcoming slowdown or recession. And 3, the fear now is about the fear of inflation, the yields rising, and note that we don't have any data suggesting inflation is permanently here to stay. Look at the job figures. Not everyone has jobs. The real purchasing power, the real purchasing income is not there. So how can this signal a severe inflation? So I think here are my 2 solid conclusions here. 1, this is not a bear market happening before our eyes. It's a corrections, and buying the dip is likely right move. An overall sell-off right now is irrational, just like in December 2018, with the exception of growth stocks that are very overvalued, especially in the context of rising yields. And 2, no one can predict how deep this correction goes, but it would be prudent to buy the dip on cyclicals, financials, and growth stocks that are already undervalued. And please also note that the S&P 500 is now so heavily weighted to the top market cap growth tech stocks like Facebook, Apple, Netflix, Amazon, and Google. So you can see that from this list, the top 10 holdings accounting for 26.95% of total assets in the SPY or S&P 500. That's a 10% corrections in these big names require 90% increase in the bottom 100 stocks of the S&P 500 to avoid a fall. So the best way to increase your portfolio compound annual growth rate may not be to simply buy the dip in the S&P 500 index, but rather choosing the above sectors or stocks that avoid this into this weighting. Additionally, let's watch Warren Buffett has got to say about his first stock purchase.
You went back to that day in 1942 because it was the day you purchased your first stock, which point out you were 11 years old then.
Right.
So
yeah, and the day I bought, I mean, the headlines.
The other side.
Yeah, the headlines were terrible every day. Within 2 months of this.
This is the New York Times from 1942 that day.
Yeah, the 1942 New York Times sold for 3 cents. And I also got the headlines from some days before, and everything was going badly. The Philippines were going to fall within 2 months. Things were grim in Europe. Our ships were being sunk, and the war was bad then. And that day that I bought, March 11th, the Dow Jones cracked 100 on the downside. There was a 2% decline, which would be 500 points today. And the night before, on March 10th, I said to my dad, I want to go all in. I had $125, and I put every bit of it in 3 shares of City Service Preferred, and which is still my personality, is to shove it all in.
As we've seen with Apple.
Yeah, somewhat. And as I pointed out to the crowd, I bought that stock at 38 and a quarter. It was down from 84 the year before, and it was down from 55 in January. And I thought, I'm really buying it cheap. So it went down to 27 after I bought it. And then I did it, and it went up to 200 later on, but I sold at 40.
So my point is, in every dip or corrections in the market, buy the stocks. because the general consensus is that the stocks will go up. When you're young, don't invest in bond. Stock is always a better solution for wealth accumulation. Thank you for listening to this episode. I'll be back with more analysis of some of the undervalued stocks that I think are very reasonable priced right now, and you should add to your portfolio whenever you are ready. Thank you, and goodbye for now.